Hallelujah! The world economy didn't crash in September or October or even November like many had speculated. But did you see what happened this summer with Greece and with China? Even though economic Armageddon didn't happen, everyone is still panicked and wondering what is going to happen next and if it's still a good time to buy gold or silver. From my conversations with people over the phone here at goldsilver.com, I'm hearing that they feel kind of lost, demoralized, and seeking guidance, especially since the financial world as we know it didn't collapse or crash in the fall. And now, with interest rates possibly going up or not, how does that fit into the overall economic picture? No one can know for sure, but based on history, we can take a stab at it. But first, in order to help us gain a better understanding, let's go down memory lane and review the three phases of a bull market. This might be a refresher for some, and this might actually be new to others. On August 26, 2006, Brent Harms, our former president and current GoldSilver.com consultant, wrote an article for GoldSilver.com explaining the three phases of a bull market. When I first came across this article, I was blown away because it described a bull market to me in a way I could easily understand, and more importantly, it allowed me to look at any market and identify which phase a market was in. That way, I could take advantage if an opportunity presented itself. Phase 1 of a bull market is called the stealth phase or denial phase. A bull market starts just as a different bull market is ending. This happens because the smart, savvy investor is getting out of an overvalued asset and getting into an undervalued asset. So most people in the media are in denial of one bull market because they're so caught up in the frenzy of another bull market. That causes the denied bull market to go up stealthily because only the smart, savvy investor is investing in it. This leads to the wall of worry. This second phase is where the general public becomes aware that this new bull market is moving higher. It is also typically the longest of the three phases. As a bull market is advancing, it doesn't feel good to the investors during this phase. The naysayers or deniers from phase 1 are everywhere, publicly explaining away the recent advances in this market and explaining why this investment class will soon drop away. They are so devastated from the losses of the previous bull market that they participated in that they're worried this bull market will cause pain as well. Meanwhile, the smart, savvy investor will still invest while the public stays on the sidelines. Only after several years of consistent gains do the naysayers start to lighten up their negativity and allow the participants to start feeling good about their investment they have made. When the media combines this new upbeat attitude with a chart of the gains that have happened so far, then the mood shifts for the better and we enter the next phase, the euphoria phase. Finally, it feels good. Most of the experts that were decidedly bearish during phase 2 have now changed their minds and are spouting the virtues of this investment class. As the media gets on board with this new idea and starts to believe in it themselves, they tend to interview the few remaining killjoy analysts that still think this investment is a bad idea, less and less often giving the public an even more biased view that this investment is it. Finally, after all these years of searching, mankind has found the perfect investment vehicle. This is now the must have investment and how people get rich. The public invests in this vehicle en masse, bidding up the prices higher and higher, accelerating the gains, making the investment that much more exciting for everyone else that has not fully invested yet. However, when the majority of investors have joined the party, then a problem starts to occur. There aren't enough investors bidding up the price of this asset to keep up the price rising as quickly, so it starts to slow down. Sometimes bull markets end with a bang, sometimes they carve a long arc on the chart as they top out and start to head down. This is where the bear slides down the slippery slope of hope. Keep in mind that in phase three, most everyone is completely convinced that this investment is almost infallible. Even as the market starts down, people are sure that this is just a temporary setback and stay invested, oftentimes adding to their positions. As an example of this mentality, at the end of the dot com bubble in March of 2000, both individual investors and also the large investment houses were so convinced that we had indeed entered a new paradigm that they just could not admit to themselves that the party was over. They kept hoping it would come back. Many of them rode the market down, wiping out much of their wealth. And down they go on the slippery slope of hope. This completes the last phase. Does this scenario sound familiar? It should for those gold and silver investors that got invested after 2011. It's been a rough ride down that slippery slope of hope. But there is hope. Everything is cyclical. Remember, we call ourselves cycle investors, and everything is a cycle. Since asset classes trend up and down in long cycles with many smaller counter cycles in them, people who have been trying to time the bottom have been caught time and time again buying into the counter cycle rallies. They were thinking that they had finally found the bottom of the market, only to have the bottom drop out of the market once again, burning the investor. So once a true bottom has formed, many participants remain highly skeptical that it really is a true bottom and stay away from the market even as the market continues higher and higher. Same problem happens in reverse. People who have been trying to time the top have been caught time and time again selling into corrections. They were thinking that they had finally gotten a pullback, signaling the top of the market, only to have the pullback reverse, once again burning the investor. So, to avoid losing out on potential future gains, once a true top has formed, many participants remain highly skeptical that it really is a true top and keep buying the market even as the market continues lower and lower. Let's avoid these scenarios if we can by trying to figure out where we are in these cycles for different asset classes. In episode 6 of Hidden Secrets of Money, Mike Maloney talks about a convergence of cycles. At the Silver Summit, Mike bluntly states that stocks, bonds, and real estate are overvalued.
Now I'm going to go to the reason I'm going to bond prices here is this is from 1980 to today. And this is a perfect bull market that goes for 35 years. Is there any such thing as a perfect bull market that goes for 35 years? This has to come to an end soon. It's an old bull market, and all bull markets end. They turn into it. Do you remember that chart that had interest rates? It had 34 years on one side. It's got 35 years now on the other side. I do believe that there's going to be one last pop in bonds because there is something that coming that I call the Bernanke bust. Alan Greenspan created the NASDAQ bubble, and with excess liquidity, he was afraid of the Y2K bug, and he created liquidity during the long-term capital management meltdown in 1998. Those things created the blow-off top in the NASDAQ and caused the crash of the NASDAQ, which is the Greenspan bust. So you've got a Greenspan bubble followed by the consequences of the bubble that he created. Then he took interest rates down too low and he kept them there too long to try to get the stock market reflated, but what happened is he accidentally created a real estate bubble. So that was another Greenspan bubble. And the consequences were a Greenspan bust. Even though Ben Bernanke presided over the Greenspan bust, it was still Alan Greenspan's fault, not Ben Bernanke's. Then Ben Bernanke created all of that currency and took interest rates down to zero and pumped the stock market. We are in the Bernanke bubble right now, even though it's Janet Yellen that's Fed chairman. We are in the Bernanke bubble, and it's going to be followed by the Bernanke bust, and Janet Yellen is left to do the cleanup work after this bust is over with. But this is going to be the biggest crash of all. The first crash, the first Alan Greenspan bubble was stocks. It was the NASDAQ, and it crashed. The second bubble was stocks and real estate. and it crashed, and that was the crisis of '08, and it was a lot worse than the NASDAQ crash. That was a global financial crisis. The next one is stocks, real estate, and bonds. And I'll show you that stocks and real estate are very overvalued. And like I said, bonds are they're nearing the end of a 35-year bull market. So this is Treasury yields, and it's just the inverse, basically, of price. As the price goes up, the yield you get from a bond goes down. So this is actually a bull market, even though the chart is descending. It's just more proof that bonds are in this aging bull market that has to come to an end soon. No bull market goes forever.
So essentially, all these asset classes are in phase 3, about to transition into a slippery slope of hope. What about gold and silver?
There are a lot of people saying that 2011 was the peak, and that was it for the precious metals bull. It's all overworth, and metals are just going down. And nothing could be further from the truth. This is not the way a precious metals bull ends. Silver peaked in April. Gold peaked in August and September. This is the way a precious metals bull ends. This is the precious metals bull of the 70s, ending in January of 1980, and gold and silver peaked on the same day. This is a panic-driven bull market. What you saw in 2011 was a greed-driven blow-off top. Things went into an exponential curve, and you had a blow-off top. And now it cleared out. What we're seeing right now is a whole lot of capitulation, where precious metals investors are giving up and selling, thinking that the precious metals bull is over. And we needed that to clear out all of the dumb money, the get-rich-quick people. They can't ride all the way to the top of a precious metals bull.
So what does this all mean now in the last month of 2015 and heading into the new year in 2016? Many analysts swear gold and silver is going to keep going down. Mike Maloney also believes in that possibility, and they might actually be right. An anonymous source sent me this interesting observation. This comes from the CME and is related to futures contracts or open interest. But before I reveal the interesting observation, let's look at this clip from Investopedia to get an idea of what open interest is and how traders can determine trends based on that.
Open interest refers to the total number of options and futures contracts that are not closed or delivered on a given day. Open interest is valuable because computing the total number of opening transactions provides important clues about the liquidity of options and future price movements. For example, in the case of Smarmy Consulting, the company has 1,000 open contracts. A trader might interpret this as a lot of secondary market activity for a mid-sized firm, which usually means a better chance of getting option orders filled at an attractive price. This can encourage more derivative trading. Active investors also use changes in the open interest to predict where the underlying securities will go. An increase in Smarmy Consulting's open interest that coincides with an uptick in its stock price will usually be interpreted as an upward trend. On the other hand, if open interest rises when the price drops, it typically confirms a downward trajectory. In fact, traders who track open interest may look for a number of pricing signals. For example, high open interest during a market peak is considered a downward sign when the price drop is sudden, since many investors with a long position will have to liquidate. While a lot of derivative traders focus on factors such as volume and price, knowing how to interpret open interest can bring a new dimension to their analyses and provide a deeper understanding of underlying trends and conditions.
So to recap what the video explained, open interest will tell you the total number of option contracts that are currently open. In other words, contracts that have been traded but not yet liquidated. Open interest also gives you key information regarding the liquidity of an option. If there is no open interest for an option, there is no secondary market for that option. When options have large open interest, it means that they have a large number of buyers and sellers, and an active secondary market will increase the odds of getting option orders filled at good prices. So, all other things being equal, the bigger the open interest, the easier it will be to trade that option at a reasonable spread between the bid and ask. So, by monitoring the changes in the open interest figures at the end of each trading day, month, or year, some conclusions about activity can be drawn. As the video explained, an increase in open interest along with an increase in price is said to confirm an upward trend. Similarly, an increase in open interest along with a decrease in price confirms a downward trend. An increase or decrease in prices while open interest remains flat or declining may indicate a possible trend reversal. Now, for the interesting observation from my anonymous source. If you look at this document, it's the open interest report for gold 100-ounce futures contracts. This document is dated August 6, 2015. You can see that the number of open interest contracts takes a huge jump from 26,713 in November contracts to a whopping 310,562 December contracts. So there are a huge number of unsettled contracts, and this should create a good buying opportunity. Again, as the Investopedia video explained, you can use the open interest contracts as a gauge for trend and price direction. Since the gold and silver price has been falling since 2011 and open interest has been rising and continues to rise until December, it's an indication of a weak market and prices should not rise until after the new year. You can see that starting in 2016, the open interest starts to decline into the fourth quarter of 2016, and since the settlement price is increasing, then that dictates the market or price should remain weak or volatile. But a weak market doesn't necessarily mean price weakness. It just refers to the interest. Interest is weak in the market. But then in 2017, you can see that the open interest starts out low and then increases while the settlement price is increasing, which dictates a strong market. The futures market is a fluid market and changes according to sentiment and needs. If you go to the CME Group's website and look at the current open interest, you'll notice that the big jump in open interest in December has changed to February. High open interest for a given option contract means a lot of people are interested in that option. However, high option interest doesn't necessarily mean the people trading that contract have the correct forecast on the stock. After all, for every option buyer expecting one result, there's an option seller expecting something else to happen. So open interest doesn't necessarily indicate a bullish or bearish forecast. Either way, we're close to the end of this slippery slope of hope in gold and silver. Now more than ever, it's important to keep accumulating or keep stacking and prepare for this rebound. I also feel that we're near the bottom for both gold and silver because starting in mid-November, sellbacks in our company have increased, and there have been a few days where we've made more on sellbacks than actual sells of gold and silver. This is a good sign. The public is always wrong. The public buys high and sells low. Don't give in and don't give up. Let us help you take advantage of this current situation. We know a lot of our clients have already invested what they could, while others might not have a way to invest. But right now, there is a good opportunity for homeowners or real estate investors. Janet Yellen and the Federal Reserve is on the verge of popping the biggest bubble in history. Once interest rates go up, and they will, the bond market is going to have a huge exodus and roil the stock markets. We are literally at the turning point of most of the major markets, as Mike Maloney has explained. This increase in interest rates will also contribute to real estate prices going down. If you look at the Case-Shiller Index, national prices are already decelerating. So this is a good time to consider selling your real estate at the top or close to the top, or consider cashing out by refinancing your home. You can actively participate in the change of the upcoming wealth cycles. Mike Maloney calls himself a cycles investor and teaches the wealth cycle and how to realize a personal gain. For those not familiar, let's hear Mike explain it.
What is a wealth cycle? Basically, investors, the public as a whole, rushes from one asset class to another to another. We rush into paper assets like stocks, and then we rush over to real estate, and then we rush back to commodities like oil and precious metals. And then, the cycle sort of repeats. If you look at it, these different asset classes that people rush back and forth to, one asset class will get bid up too far, and another asset class, that currency is being drawn away from one asset class and going over to a different one. So one is becoming undervalued while one is becoming overvalued. If you measure this with a graph and you start measuring one thing with another, instead of measuring real estate or the stock market with dollars, you measure them with barrels of oil or ounces of gold. Then you find out that your home and everything else is trapped in this cycle that goes up and down, where your home will become overvalued and then undervalued and then overvalued. When everybody rushes into real estate is overvalued. Then real estate goes into a bear market and everybody finds something else to invest in, and real estate becomes undervalued, and that thing that everybody else is investing in becomes overvalued at that point. Real estate and precious metals. You measure one with another, you see that this is only half of a wealth cycle. This one becomes overvalued, and it can't become overvalued forever. Precious metals can't eventually buy an infinite amount of real estate. It can't buy the whole planet. And that's what would happen if this went on forever. One becomes overvalued, the other becomes undervalued, and then you have a second wave, the other half. One goes into a bear market and the other one goes into a bull market. So if you're measuring one thing with another, what you discover is that everything is pretty much trapped in this range I call a valuation channel. To me, the trick is when something becomes overvalued, this one, you want to sell that thing and buy this thing down here that's undervalued. You've now made these gains and you've purchased this thing very inexpensively. This is what the wealth cycle is all about different asset classes outperforming another asset class. It's about true value. It's about how to see true value. Being able to see the future with these wealth cycles, you have a huge advantage over the rest of society that isn't paying any attention to this, that doesn't really care. They're just reactionary.
With so many asset classes changing phases, many opportunities are available for those who can take advantage of them. But you have to have disposable cash to take advantage of these opportunities. With real estate about to tank and interest rates about to go up, it makes sense to borrow at low interest rates before they go up. Then just sit in cash. Yes, cash. I know there's been a lot of chatter about the dollar collapsing, and I agree, the dollar is going down, but not right now and not in 2016. The dollar is also on the cusp of a change in its cycle. Currently, it's in phase 2. It's in the wall of worry phase. Many people are swearing that the dollar is going to collapse, but if you look at the dollar and compare it to most other major currencies, the dollar is going up. Let's be real, the dollar is the prettiest ugly girl. The US is still the best economy on the planet. But look at the dollar chart. Its trend overall is going up, and it will go into phase 3 next year as the global economy continues to get worse and we enter this deflationary phase Mike talks about. Then the dollar will collapse like most bubbles do when they go up in this upward trajectory. If it doesn't collapse by itself, then it will be devalued like it was in 1934 or like China recently did to the yuan. So keep stacking. The Great Depression was very deflationary, but the US still revalued gold and devalued the US dollar. It could happen again, especially if we keep experiencing deflationary pressure like Mike Maloney has mentioned. Remember, we are stackers or accumulators, not traders. Price is irrelevant right now. Only wealth security matters. And the only way to secure your wealth is by protecting it with gold and silver. Keep in mind what Mike talks about when it comes to lower gold and silver prices.
I do believe that we are going into this short-term deflation. So I believe that you could see silver fall to single digits again. It could fall to like $7 or something like that. I think that there's a good possibility that you could see the gold-silver ratio go back to 100. Now, I might be wrong. The bottom might be in. But I see a deflation before the world's central bankers overreact and start printing their currencies into oblivion because they're so conceited they think they can control things, and they really can't. All they do is they create a bunch of excess economic energy that gets released by the free market later. They can do short-term manipulations, but the market always balances it out. So one of the things, if we do see single-digit silver, you're probably not going to be able to buy physical for that. What happens is all of the futures contracts and options and stuff, you'll be able to buy those because those are unlimited. You can make as many promises to deliver gold or silver as you want. You can't actually create the gold and silver to back up those promises. So you might see the price fall to $9 or $7 or something like that. But what will happen is the spreads will go huge, and you'll actually be paying more for an ounce of silver than you will today just buying it right now. So personally, what I do, people say, well, if I love gold and silver so much, why am I selling it? Well, I buy gold and silver on a regular basis for myself, but I'm also a dealer where I purchase out of the wholesale market and sell to the public and make a tiny little spread. That's how a dealer works. So I'm not selling my own gold and silver. I buy every month. I do accumulate some gold and silver, and then sometimes I make larger purchases based on technical factors or something, or fundamental factors such as gold and silver are just undervalued right now.
So the play right now should be sell or refinance real estate, take advantage of the high real estate prices and low interest rates, sit in cash, and let your purchasing power go up while simultaneously stacking now and into 2016, along with waiting for when the dollar pops and the US falls back into recession next year as interest rates start to go up. Now, I'm not a financial advisor, but I am a licensed real estate broker in California. Plus, I can do home loans in all 50 US states. So I can speak on real estate and interest rates and make recommendations. That's why I took a leave of absence from goldsilver.com. It was to get my broker's license ready for this change and be ready to help you stack gold and silver and stack them efficiently. Before I left, I introduced our insiders to my OPEX dollar cost averaging strategy. This insider video is from September 2013, and in it I describe when to buy using the options expiration dates as a guide. Plus, I mentioned to expect a lot of volatility and buying opportunity in the end of 2013. What happened? Well, December 2013 did see great buying opportunities, and both silver and gold closed near the low of the year for 2013. By using my OPEX strategy, you can dollar cost average throughout 2016 and become an efficient accumulator or stacker. Using the OPEX strategy allows you to correctly and accurately guess the low for almost any given month. Call me now to see if you qualify for a cash out refinance or if it makes sense to sell your real estate. Thank you for your continued support in 2015, and we here at goldsilver.com wish you happy holidays and a happy new year.
Thank you so much, Mike, for watching this video. Again, please excuse the quality of the video. I just put this together within the last few days as an example of how to deliver the message to goldsilver.com subscribers. It's just a rough draft, obviously, nothing's final. But I do believe this marketing piece sets up goldsilver.com for taking the lead in these uncertain times. Clients will get the guidance that they're seeking, and for those that it makes sense for, we're going to be able to load up people with disposable cash to spend on gold and silver. And whether they sell or refinance their homes, sell or refinance their investment properties, they're going to have cash to spend. And also by showing them the futures contracts trends, we're able to provide an ambiguous timeline, and combined with my OPEX dollar cost averaging strategy, we can get clients buying on dips throughout the months ahead and into 2016 and get them back on a consistent buying schedule. Now, because of RESPA laws, unfortunately, I cannot share my commissions that I would earn on these transactions, but I am allowed to spend on advertisement, and I would happily pay goldsilver.com $300 to $500 per lead closed, Similar to how companies sell leads for a set price, well, I'm open to negotiations if you think this idea makes sense. Plus, I'm even open to renting out John's office and providing, making that my office space for my mortgage company and that real estate side. Again, I'm open to spending, $300 to $500 a month for that office space, if that makes sense to you. Now, I believe goldsilver.com has 130,000 subscribers. Now, let's subtract 25% that are international clients. And again, I'm just guessing here. I don't have the exact numbers, but either way, I couldn't help them out. And let's also assume that another 25% don't even own a home, just don't qualify or anything like that. They're not real estate investors. Well, that leaves roughly 65,000 potential interested leads. And as an example, let's use an average of $400 per lead close that I would pay goldsilver.com. Well, at a 1% success rate, that translates into 650 loans times $400 paid per lead equals $260,000 cash infusion into goldsilver.com by just simply sending a few email blasts. It costs goldsilver.com nothing to do, just time and a few man hours. Now, $260,000 divided by, again, I'm guessing here, a 2% profit margin average that's made per deal on goldsilver.com on metals, and that equates to roughly $13 million in gold and silver sales that $260,000 would equate to. Plus, let's assume that the average person cashes out about $30,000 or makes $30,000 in proceeds from their real estate sales. Well, that's 650 people times $30,000 equals another $19.5 million that our clients would have to spend. Now, how much we capture from those sales is debatable, but either way, goldsilver.com is going to capture some of that money and is going to get a few more $1 million in sales from those proceeds. Plus, this video also plugs in personalgain.com and could be a good intro to personalgain.com or supplement to current marketing that's going to happen, and could also serve as another avenue to capture emails and subscribers for personalgain.com. Plus, this could also be the beginning of clients being familiar with our real estate services and platform and loan mortgages, getting ready for the next wealth cycles when you issue your exit strategy to move on from goldandsilver.com to cash flow real estate, or if it's dividend yielding stocks, whatever it may be. But the point is, they got a taste of that because I can offer the lowest interest rates. I will offer the lowest interest rates, even if I have to make nothing. As long as we get the deal, get a referral, trust me, we will going to have satisfied clients, which is going to help the overall reputation of everybody. Now, again, thank you so much for listening, Mike. I appreciate your time and consideration. Even if you shoot my idea down and not interested, I know you took time out of your day for this, and I appreciate you giving me this shot and opportunity. Take care and enjoy the rest of your weekend. Bye.